Have you been flirting with the idea of a Roth conversion? All the cool kids are, yours truly included. And I'm not talking about those piddly little backdoor Roth conversions. No, no. I'm talking about high income earning clients in their 50s and 60s, still working, yet looking to slowly convert portions of their large tax deferred accounts into Roth. Now, if they're already at this point, then they've considered the big things like what is my tax rate today? What's it going to be in the future? What is my income today? What's it going to be in the future? Am I actually going to use this estate or am I going to pass it on to somebody else? So those are the obvious considerations. I'm here today to share with you 7 little nuggets that you and your advisor probably haven't talked about. Number 1, yours and your spouse's life expectancy. Yes, when a spouse inherits an IRA, it is generally a non-taxable event, but most people forget about the so-called widow's tax. You see, when you go from married filing jointly on your tax return to filing single, then your tax brackets condense and your standard deduction drops drastically. So if we're projecting future tax rates, we need to consider the odds that one of you will be widowed. And here in America, 1/3 of individuals over the age of 65 are widowed. Number 2, of course, we're considering federal taxes, but have you thought about state taxes? If you live in a high state income tax and you're considering moving to a state with little to no income taxes, it may make sense to hold off on that conversion until you complete your move. Number 3, politics. The Tax Cut and Jobs Act is set to sunset on its own in 2025. And without the intervention of Congress, then we already know marginal tax rates could be increasing and the standard deduction could be decreasing as soon as 2026. Number 4, you don't have to have an IRA necessarily to complete this strategy. Most people don't realize that you can potentially do a Roth conversion inside your workplace plan. Now, it is dependent upon your company's plan and the plan document, but just know if all of your wealth is tied up in a 401k or a 403b, this strategy may still be available to you. Number 5, are you feeling particularly charitable? If that's the case, you may not want to do Roth conversions because generally speaking, distributions from an IRA to a charity are not taxable. So there's no need in prepaying a tax that may not need to be paid. Number 6, your timeline to withdrawals. Stop considering your retirement date as the end. Just because you're a few years from retirement, that does not mean that you won't benefit from the tax-free growth that is inherent in the Roth. You see, once we move the money into the Roth bucket, we've put it into an account that is not subject to RMDs. So if you don't need the funds, we don't have to liquidate them right away. That bucket then becomes your long-term bucket, and you have the potential for decades of tax-free growth. And then finally, number 7, if you are considering a conversion, a down market may be a good day for you. You see, when you make a conversion, you don't necessarily have to liquidate the underlying investments, which means you can maintain that long-term investing strategy and you're not having to cash in and out of the market. But you could recognize the distribution and the conversion during a down market, which means your reported income could be repressed, all while you maintain that investing strategy and hopefully rebound on the back end. If you have questions about Roth conversions, or if you're an HR professional and you're not sure if your plan allows for Roth conversions, give us a call. We'd be happy to help. This is Jeannie Fisher, the 401k lady.